So today I just got my quarterly statement from my nationwide variable universal life accumulator policy. So I did a video talking about overall how I invest in whole life insurance. There's three types to summarize. There's term life insurance. There is variable universal life and index universal life. So today I want to talk about my variable universal life policy, which I have through Nationwide. So let me break it down here. I have this statement in front of me, so I'm gonna read off of it and then analyze it as well. So for me, I chose to do a $2 million death benefit. So the death benefit, it's based on your net worth, it's based on the assets you own, and based on the risks that you are exposed to, right? So for me, because my net worth is over $5 million, it's reasonable for me to have a life insurance policy that's $2 million. Um, Insurance companies want to make sure that you're not overinsured. So let's say I'm worth 5 million and I want a $50 million life insurance policy. They may be a little bit cautious and they may be a bit wary, and I probably couldn't afford it, to be honest. So that's kind of the first concept, is that you don't want to over insure yourself. And so that's key, right? So for me, I did this policy back in 2019. So at the time, I don't know what my net worth was exactly, but I think a $2 million policy made sense. And I have a $1.5 million index universal life policy, which I can do another video on, talking that one in depth once I get my quarterly statement as well. So the next line is the death benefit option. So I chose option 2, which is increasing. So what that means is, as I mentioned earlier, when I pay my monthly payment into this variable universal life policy, the minimum amount for me to invest is, I believe, let's see, about $500, right? But you don't want to invest the minimum, right, or put in the minimum. So if the minimum, just to keep the policy alive, to cover the cost of insurance, is $500, you want to maybe put in, let's say, $2,500, right? So what happens is 500 goes to pay for the insurance, and the remaining 2,000 gets invested into like different index funds or mutual funds, which I'll go in later, which ones I picked and why. So for the quarter, what they do is they tell you the beginning cash value that you have. So I have $100,000 of beginning cash value, and I have a ending cash value of $114,000. So in this quarter, I made $14,000, which includes my premiums I put in, and then what's coming out with fees and how the stocks are doing. So in this past quarter, the stocks did pretty good. So that's why I have 14,000 in growth, right? So next is, they have outstanding loan balance. So if you were to take a loan against your insurance policy, this is where it would state, right? Surrender charge is $29,000. So if I were to cancel this whole life insurance policy today, I would have to pay the life insurance company about $29,000. So the surrender charge is built in place to protect the insurance company, because like they want to make sure you're in this for the long term. So they want to put a penalty if you were to close a policy early. So let's just say I decided to cancel my policy, I have to pay $29,000, right? And the insurance does this to cover themselves, to ensure that you're in this long term, right? So after that, it's a total surrender value available. So that's essentially my cash value, which is 114K, minus the surrender charge. So it's roughly around 84K. And they'll say the change in value. So they said that I made about $12,000. And then this place, it will say, okay, how much net premium applied. So I put in $500 a month, because I'm not funding it heavily right now. I'm actually doing minimum for right now. Once I build up my reserves, I'm gonna max fund it again. And then monthly deductions. So these are the fees. So I paid about $1,000 in fees. So as I mentioned earlier, this is just to keep the policy afloat. And then it says investment performance. So since I got this policy in August 24 of 2020, so about a little under 4 years, it grew about 12%. And in the past 12 months, it's done 34%. So it's pretty good, right? And then here it shows my allocation of what I bought. So let me skip to the next page here. So once again, it breaks down a lot of what you have. So um, right here, for example, my beginning cash value is $100,000. Net premium applied is 1,400. Change in value by growth is 12,000. Uh, Monthly deduction is 1,000 for fees. So this is my ending cash value of 114. My surrender charge is 29K. That leads me to about 84, right? Okay. And then here it breaks down my stocks. So I kind of show what stocks I chose. So I'm doing the S&P 500, right? That's my bread and butter. And I allocate about 55% of my premiums to this. The next one is the Fidelity Growth Fund, which is 10%. The Small Cap Group Index Fund, which is 15%. I'm doing a kind of a health global technology index fund of 10%. And the last one is a T. Rowe Price Health Science, which is 10% as well. So if you kind of look at my breakdown, most of it's an SP 500, and the rest I just kind of put out there. So this one's a bit unique. I didn't do international. I didn't do any bonds because my other index funds through Vanguard, which I'll do a deep dive later, I invest more in like international and bonds. So for me, this is a little bit diversified, but the bread and butter is S&P 500, right? So that's kind of my personal investment philosophy. I just, believe in the U.S. economy and do it long term, and it'll do well, right? Done great for me so far. So let's see here. And then on your policy, you want to delineate your beneficiaries, right? So if you have a living trust like me, I designate my living trust, or you can designate your parents, your siblings, whoever it is, your spouse, right? And let's see here. This packet is roughly so. Okay, let me break down some of the fees here. So every month I put in $500, right? So for January 1st of 2024, I put in $500, and out the gate I was charged a $30% of premium charge. So insurance companies make a lot of money through fees, which is why they have a bad rap, because there's a lot of fees. But like you said in my last video, there's a specific purpose in investing in life insurance. It's tax-free wealth, and it's in addition to what else you're doing, right? It's not just a solo thing. So out the gate, okay, I put in $500, $30, the percent premium charge is taken away, so I have $470 of net premium. And at this point, let me do my other fees. So there is a monthly deduction, which is the cost of insurance, which is $364. So I have $100 left, and then pretty much that is it. So out of $500, about $100 goes into my investment strategy, right? So that's what I mean by you have to maximally fund this. So out of $500, only $100 after all the fees gets invested into my index fund portfolio I just listed earlier. But if I were to put in $2,500, the percent of premium charge would be a bit higher, but the cost of insurance stays the same, and there's more of an excess, right? So maybe I'll have, $2,300 that gets invested, right? So this is what I mean by max funding it. And then here, let's see. It breaks down individually how each of your index funds do. So that's most of the pages, like how many units do you own, how are they doing, what's the growth, what's your allocation. If you want to change your allocation, great. It's up to you, right? And then I want to find, okay, this is the page that I want to talk about the most. So there's a page, it says total premiums paid since policy inception. So I put in $111,000 into this policy since I owned it, right? So I put in $111,000 of premium since I own this, and it's the overall policy is now worth $114K. So I basically made $3,000, and it covered all my expenses for covering my insurance. So in a weird way, since I own this policy in 2020, it's free because my index funds grew, and that growth of the index funds covered my cost of insurance. So it's kind of like doing a burr strategy with your life insurance policy, right? So remember, My cash value is 114K, but I put in 111K worth of premiums. But remember, I'm paying for the cost of insurance, these other fees, right? And it says here is additional premiums allowed, and that's 87K. And I'm on policy year 5, right? So you can max fund this policy over 7 years. So let me read this out word by word and then explain it. So as of the end of this statement period, the maximum premium that can be paid and your policy still qualifies life insurance for federal tax purposes is $87,000. If this amount is paid in full, your policy may be considered a modified endowment contract, MEC, as defined by the Internal Revenue Code. MEC is life insurance. However, distributions may be treated less favorably by the IRS than distributions from a non-MEC. Right? So let me summarize this. So right now, if I were to lump sum $87,000, I would have maxed out the amount of premiums I can put into this life insurance policy while still gaining that tax-free distribution advantage. If I were to put in $1,000 more, it would not be considered a as favorable, right? So you have to watch this number, right? So like I don't have a lump sum of $87,000, so it's not an issue, but you're allowed to max fund a policy over 7 years. I'm on year 5 of 7, right? So in year 6 and year 7, if I put no additional contributions, the total amount allowed is $87,000, right? So let's just say I got a windfall of money and I want to catch up, right? Because I've been putting $500 a month, which is I'd say the bare minimum almost, right? I think $400 is the bare minimum. I'm putting in 500. So if I had a lump sum of $87,000, I could put in a lump sum right now, right, and stop payments for probably a few years, right? And at that point, I can look at this number again and see where I'm at. But you never want to cross this number, right? So you always want to track it. If you listen to my other video, you want to max fund your policy over 7 years, right? But how you fill it up over 7 years is up to you, right? Like for me, personally, I max funded for the in 2020, in 2021, in 2022, but in 2023 and 2024, because I was buying so much real estate, I decided to not max fund anymore. So as a result, I fell behind, but I can always play catch up now, right? So if one of my real estate gives me a lump sum of money, I can take that money, put it into this policy to catch up, right? So that's what I love about life insurance. It's the flexibility. So yeah, that's at a high level. Just really want to do a deep dive onto my nationwide variable universal life policy. Why I chose this one, I have no idea. The life insurance agent I was working with just showed it to me. And just remember, variable universal life has fewer fees than index universal life, which I have through Transamerica, but it goes up and down and rides the market, right? So I'm going to do a deep dive on my index universal life insurance policy in Transamerica if you want me to, but please put your questions down below. I know it's a confusing topic. Would love to hear your thoughts, or if you have own a life insurance policy. Once again, I know it gets a bad rap, but it serves a purpose, right? It serves a purpose for, I personally think, for high net worth individuals who are looking to grow wealth tax free. And yes, there's more fees, right? So that's the caveat, but please share this video with somebody who's thinking about investing in life insurance. And please like, comment, subscribe, and hope to see you next one. Thank you so much.